Markets are still in seasonally the best 2-week period of this year, which starts July 1st and goes through the first 2 weeks of July. During this period of time, the S&P 500 on average tends to rally about 2%. And lo and behold, you have already seen a 2.1% rally during this period in time. So what's coming next for markets as we gear up for the first earnings of this earnings season, be it with your banks that start this week? We also have some major economic data that you need to know about, which all of this could lead to a pretty crazy week ahead. So yes, historically, the first 2 weeks in July are very strong. The back half of July, the second half of the month, is not nearly as strong and is actually one of the worst periods of the year. So history would suggest this upcoming week could be strong, but then again, we have economic data and we have a very unusual market right now. Just to point this out of many others, the S&P 500 made a new all-time high close on Friday with just 43% of the components above their 50-day moving average. So what? 57% of stocks are actually in an active decline, yet the market's hit a new all-time high. In the past 25 years, the only other time we've seen an all-time high with less than 45% was December 1999. And what tended to happen is you got a 10% correction at that time. Then you've seen about a 15% rally, markets traded sideways for a period of time, and then you got the collapse of the dot-com bubble. Not suggesting that this market is a bubble or we are going to see a collapse by any means, but it does tend to set you up for a correction at the bare minimum. As I have said before in many videos, I believe if we do get a correction, it's going to be a rotational correction. The areas of the markets that are in active declines, that are quality companies, may start to actually catch a bid as some of your more overvalued, some of your more crowded stocks see a sell-off. In this rotational correction, I could actually see Apple, Nvidia, Microsoft, Google, Amazon, these stocks that are all-time highs, include Meta and Netflix in that as well, actually sell off 5%, 10%, and that capital could just go into other areas of the markets. It could go into Tesla, it could go into PayPal, it could go into small cap stocks, the areas that have not participated as much. Let's be honest, if people actually think we're going to get a soft landing anyways, you're going to see some capital go into small caps, into other stocks besides just the Magnificent Seven. So yes, you could actually get a correction in the S&P and the NASDAQ, but actually see the internals of the markets catch a bid and actually move higher, just because of the concentration of market cap weighting within big tech. Especially if, again, you believe we're actually going to get a soft landing, and if Jerome Powell this week comes off a little bit more on the dovish side, I would expect to see that rotational correction, to see big tech get sold, and for that capital to redeploy into small caps, mid caps, and just random stocks. Basically everything that is not in the AI stratosphere, which is like 99% of the market. As Mac10 says on X, 96% of stocks did not confirm the S&P's new all-time high this week. And here's how that looks on the chart. He says, as we see, the last time we saw the same pattern was the end of December of 2021. Another example of algo-driven futures levitation in a holiday market. So basically saying that Wall Street is off on vacations. Nobody wants to change their mind. You're just seeing the algorithms driving this market higher, and I tend to agree with that. Michael J. Kramer on X says shipping rates are surging, yet no goods inflation, 7 to 8 months lag. He says it's coming. I don't agree with this. I think inflation is dead. So I'm actually in the inflation is gone camp. After all, if you look at harmonized CPI, if you look at actual market rents for rent instead of owner equivalent rents, then you're actually sub 2% CPI. Of course, the Fed doesn't realize this yet, and who knows if they ever will. Tom over on X says S&P NAAIM reflects the overall sentiment of active investment managers that hit 103.66 on Friday, usually mark short-term tops with consolidation and pullback soon. This is not a crash call, but a 2 to 5% pullback on the horizon, which, just in case someone does not know this that's listening to this video, corrections are healthy. Price discovery is healthy. Without price discovery, you get bubbles that burst and don't ever come back for years. I've gotten attacked in the comment section of the last couple of videos to even suggest a correction could be possible. That leads me to believe that a lot of people have forgotten that markets can and should go down during periods of time, that is actually healthy for a bull market. Whether or not you want to hedge or sell your portfolio because of a simple correction, I don't think that's smart, but hey, do what you guys want. Personally, I never sell the long term, ever, unless the a company or companies in that long-term portfolio change for the worst, right? If companies are making decisions that I don't agree with, that I don't see long-term value in, then I will sell individual companies. I have never once sold everything because I thought a correction or even a crash was coming. It was easy to see the COVID crash that was coming. Made a lot of money on puts, but I didn't sell the long-term portfolio. And that's not what I would ever suggest to do anyways. You never want to bet against America long term. Can there be ways to hedge your portfolio? Of course. Simply just buying puts can be a good way to hedge if you're concerned about a correction, if you're over leveraged or on margin. That's why I suggest a correction could be coming, because statistically it should be coming. And the sooner you have that information, the more money you can make off of it trading, or the more effective your hedging can be. And this, I think, is pretty damning as well. Bar chart post on X, total put to call ratio drops to the lowest level since January of 2021. And obviously during January of 2021, when you were at those levels, that was, during a period of time that the markets continued to do well. But if you look here at November, you also hit very low levels as well. And that did precede a volatility spike. Typically, this does precede volatility spikes. Anytime you do drop this low, you do tend to see a spike shortly thereafter. And that would be more puts that start to be bought, and would suggest a pullback could be coming soon. As Seth Golden says on X, my favorite longer term indicator, cumulative net new highs briefly looked like it wanted to turn over, but then broke higher. For now, this still informs the long-term trend remains bullish and resistant to bearish notions and or nonsense. But I would agree with that. I would agree that you likely get a rotation and a broadening out in our markets, and overall the bull market is intact until the Fed makes an error, until the Fed pushes this economy into recession or cuts rates for the first time. I think you're just fine and stocks can continue to do well. Historically, markets fall about 23% for the S&P 500 when the Fed cuts rates the first time. Will that happen again? It depends why the Fed is cutting rates. If the Fed is cutting rates because inflation's falling and the economy is doing good, then I would not expect a large sell-off. But if the Fed is cutting rates because the economy is weakening, then maybe you get a larger sell-off. That's just what history would tell us. Now, for this Friday's expiration on the SPY, the ETF that tracks S&P 500, you can see call open interest is 16.19%. Put open interest is 83.81%. That means you got about 5 times as many puts compared to calls. And there was a decent amount of put activity coming through for the S&P 500 in the last couple of minutes of the trading day on Friday. Just to point out a few of these, you have this trade in August 16th, 521 put worth $1.16 million. That's a large trade. In August 16th, 527 put worth $1.51 million. In August 16th, 538 put worth $34,000, and a couple calls, couple more puts, July puts for July 19th, 548 put worth $200,000. But those were some notable looking trades. These are pretty wild trades. A June 20th, 2025 450 put worth $141,000. A June 20th, 2025 465 put worth $169,000. Those are some pretty bearish trades. A December 18, 2026 455 put worth $457,000. So when you actually look at some of the trades coming through, some of them are starting to look more negative. And I mean, overall, that's the prudent thing to do heading into a new earnings season. I mean, last earnings season, you dropped 5% following big tech reporting earnings, almost 6% on the S&P 500. And I would argue the expectations are even higher now because look where the markets are compared to then. Could you see a similar pullback to that? Could you see a 10% pullback? Probably. And I think the real problem is markets are expecting around 12% EPS growth for 2024 and almost 15% growth in EPS for 2025. Markets don't care as much about 2024 anymore. They're looking forward to 2025. And when you're already expecting 15% EPS growth, there's a lot of good news priced in. Could estimates go a little bit higher, maybe to 16, 17%? Of course. But that would be historically in like the top 5% of bull markets. As the economy weakens, as the Fed maybe continues to be on the defense, like we're not going to start cutting rates, we're not even thinking about starting to cut rates, we'll know more from Powell this week, then it becomes less likely and less likely the S&P will hit those earnings. Put it like this, with each bad data point, ISMs, PPIs, CPIs coming in a little bit hot, sticky, GDP reports, retail sales, consumer spending reports that come in bad, every one of those reports lowers the odds incrementally that we will hit those EPS growth targets for next year. And should the estimates be 15% EPS growth next year? I think that's pretty rich. Should they be 10%? I think that's more accurate. I think that's more appropriate. But falling from, let's say, 15% to 10% would cause a correction at the bare minimum. As far as earnings this week, you have a couple companies reporting Monday, Tuesday, Wednesday. Thursday in pre-market, you have PepsiCo, Delta, Conagra Brands, and Bank 7. Friday is when you get your large banks that report pre-market, JP Morgan Chase, Wells Fargo, Citi, and BNY Mellon. The biggest implication that banks have for the broader market is what do bank accounts look like and how are people spending money? Are people still spending a lot of money? Are they starting to pull back a little bit? That can actually have a larger implication for the broader earnings season and the broader economy. So those bank earnings will be important coming on Friday. But this week will mainly be all about the economic data, in which on Monday at 11 o'clock in the morning, you will get consumer inflation expectations. You're actually expecting a sharp fall from 3.2% to 3%. And this is a 12-month ahead view. So you want to see that fall. You want to see that come down. At 3 p.m. on Monday, we will get consumer credit change. You're expecting about $7.9 billion of added credit. Last month was $6.4 billion. The more, the better from the market's perspective. The more debt people are adding, the more company earnings can, come through with estimates. Now, Tuesday, you will get Fed Bar that speaks at 9:15 in the morning, but it's all about Jerome Powell that speaks at 10 o'clock in the morning. Now, Jerome Powell is speaking in front of Congress. He will be asked some very hard questions. This will be unscripted. So we'll see what he says. If he talks about still cutting rates by the end of this year, if he talks about cutting rates multiple times by the end of this year, obviously, the markets are going to pay very close attention to every word that Powell says. So I will also pay attention and hit that subscribe button if you guys want to know exactly if Fed Jerome Powell says anything that you should know that can and likely will affect our markets. Now, at 12:30, You will also get Fed Bowman that speaks. And Fed Bowman has been on the hawkish side, talking about potentially needing to raise rates again, which is not the view of a lot of Fed officials. So watch out for her coming 12:30 if you got some calls. She just doesn't sound great when she speaks. Wednesday, you will get Fed Jerome Powell again speaking in front of Congress, this time at 9 o'clock in the morning. And I think if you're going to get any new details from Powell, it's probably going to be on Tuesday. But, who knows? He may drop new information on Wednesday. You will get a 10-year bond auction as well Wednesday at about 1 p.m. And Fed Goolsbee that speaks at about 2:30 p.m. Goolsbee, I really like him. He tends to be more realistic, kind of funny to listen to, and he can move the markets as well, as he is a voting member of the FOMC, the Federal Open Market Committee. So, I'll let you know if he says anything as well that is worth mentioning coming on Wednesday. On Thursday, it's your big data. You have CPI. Core month over month is expected at 0.2%. Last month it was at 0.2%, so not expecting much of a change there. Year over year, no change is expected. You're expecting 3.4%. And month over month on a headline basis, you are expecting that to go up a little bit from 0% last month to 0.1%. You have seen oil go up like 17% in the month of June alone. So that's going to have that impact. We'll see if that ekes its way into core as well. That would be a little bit more problematic. Now, the headline CPI year over year is expected to fall from 3.3% down to 3.1%. We will also get initial jobless claims coming out at the same time at 8:30 in the morning alongside CPI. We're expecting 240,000. We have seen a recent rise in the last couple of weeks with initial jobless claims. If that starts to spike even higher, that's going to get the markets on high alert that maybe the labor market is weakening more than we think. Fed Bostic will speak at about 11:30 in the morning, another voting member, so will be important. As well as that, you do have a 30-year bond auction at 1 p.m. also will be very important. And then on Friday, big story is going to be bank earnings and digestion of CPI, but you will get PPI as well month over month, expecting positive 0.2%. Last month was negative 0.2%. A lot of this increase has to do with energy, but you're also expecting core PPI month over month to also come in at 0.2%. Energy as well tends to play a big role into producer price inflation. PPI stands for Producer Price Index. Think of it as producer price inflation. When energy prices go up, that tends to hurt any company that ships anything, which is like 99% of companies on this earth. So that could be important, but we'll see. I don't know if the markets will respond to it too much. And then at 10 o'clock in the morning, you will get Michigan consumer sentiment, expecting things to improve a little bit across the board following a couple of bad numbers that we have seen now with current conditions, consumer expectations. You definitely want to see that improve if you are in the soft landing camp, because it's kind of hard to get a soft landing if people feel like crap about the economy. And overall, the headline number last month came in at 68.2. You're expecting 68.6. You are expecting a little bit of an increase, but what we've seen recently is some of these surveys, they're coming in really bad, like way worse than expected. So I think that is a potential risk for Friday. Overall, for this week, I'm expecting a lot of volatility from Jerome Powell. If he gives us any new information, that could be important. Trying to precondition the markets for whatever we get on July 31st. If the Fed wants to think about cutting rates in September, which markets are currently assigning about an 80% chance, I'm not sure if the Fed's going to want to do that, because it's going to be very politically, seen as politically motivated by the markets. So we'll see if the Fed kind of pushes back on that September cut. Could be negative for the markets. Overall, though, with all of this volatility, I would still say seasonally this week should be good. Although markets have already rallied that seasonal percentage we normally do of about 2%. Don't be surprised if we start to get a pullback this week, but I'm expecting the larger pullback coming from big tech earnings, which are going to be next week and then especially the following week thereafter. So can there be some weakness? Of course, history would suggest this upcoming week's going to be a pretty decent week. I think it's going to come down to Powell and CPI ultimately. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.